I've been looking forward to this for a long, long time. I met Carmella actually, I would say years ago, right? But AJ reintroduced us, and man, it's been so impactful. And we met almost a couple years ago now, I'd say, at a Panera Bread, and we were talking about the bigger picture of what's the whole financial picture look like. I've always been lasered in on the mortgage piece, and in passing, Carmela talks about student loans, and she's like getting to her story. It's not even the primary story she's telling me about, but she said something like, and correct me if I'm wrong, you said there was somebody that had to pay like $17,000 in student loans a year, that you got switched to like 3,000 a year for the first 3 years, and then it was like $9,000 a year after that for 10 years, and then it was forgiven the rest. I'm like, time out. That's a huge impact. Like, that's a lifestyle change versus somebody going, hey, can I get 6.25 versus 6.375, and it changes $5 a month on my monthly payment? Like, that's a lifestyle change what you're doing, right? And then if we could swap that out and have somebody start buying real estate, which is an asset, right? And not your primary residence, because that's not really an asset. That just gets you in the game. But then that second home, keep that first one rented out as an asset, and then you buy your next one. That's where we start building wealth. And they didn't teach us this stuff growing up. So when you look at it, when I started doing videos probably 4 or 5 years ago, out of the gate, like within 3 months, I had 30 high school kids and college kids reach out to me and go, Mr. Lagoni, can you teach me how to buy real estate? Man, I didn't buy my first property till I was 35, way late to the game. And literally some guy forced me into the house because my son was born. And he goes, you can't raise that kid in an apartment. I'm like, watch me. He's like, no, no, no. That kid needs a home. Like, you got to raise him in a home. So he literally pushes me into buying a house. And I'm forever grateful for him doing that for me. I still own that home. I still rent it out. It's a cash flowing asset for me. But the one thing I didn't realize was time, like the value of time. Like, if you can start investing when you're super young, like 18, 19, 20, then by the time you're my age at 53, man, that thing's like exponentially growing. Like, with, I don't even know how to say it. It's like the eighth wonder of the world, right? That compounding interest. So for me, I come out of the gate as a computer programmer. I go from 30 or you're from $27,000 a year to $100,000 a year in 3 years. In my 20s, the people I'm sitting next to are like, you need to invest in a 401k. I'm like, dude, what's a 401k? Like, I have no idea what you're talking about. And I start doing that, and I get off to a good start. I have savings, I have a 401k, but then 9/11 hits, I lose that job. I do this job, which is 100% commission, get crushed for like the first 8 years. I don't make much money, blow through all that money. Now hiding my truck from the repo guy, broke, trying to make the rent payments. My family's like, you need to get a new job. I'm like, I can make it. I just need more time. Well, then 2012, I start going beyond paycheck to paycheck. 2012, I'm 40, right? So like, I lost 20 years. So I'm like in a hurry to play catch up here. And so I want everybody to know the stuff that Carmella knows. To me, she's a powerhouse. Like, I've heard her speak, I don't know how many times, and she knows how to help you get there. And the goal is to be able to have financial freedom. Because, once you have that financial freedom, now you have the time freedom, which is the real wealth. Being able to do what you want to do when you want to do it. To me, real wealth is being able to take a walk at noon on Thursday with my wife for an hour, right? Or pick up and go to the gym with my son and work out with him. Be present with my family. That's the real wealth to me at my age right now. My scoreboard used to be a financial scoreboard. Now it's people. My wealth is being plugged in with people and relationships. But you still got to pay the bills, right? Like, you still have to be able to do that. And you still have to be able to buy food, and you still have to be able to live. So with that, Carmella, I've been waiting for this for a long, long time. So thank you for hopping on here, and have at it.
Wonderful. Well, hi everyone. It's nice to meet you today. Thanks for spending the morning with us. I have my partner AJ Williams on with me as well. And so we're going to do a joint presentation centered around exactly what Jeff had talked about, the value of time, and what that means not only for you, but also for your clients. So we wanted to make sure that this presentation was geared to helping you financially, but even probably more important than that, helping your business separate from other competition. I'm going to share my screen, but I'm not technologically savvy. So AJ or Jeff, you have to give me a heads up if I do it correctly.
I'm not telling you what to do. That's AJ's job.
And I hope you can see it now.
I'm married. I
Yeah, we
got
can see it.
this. Yeah, we're
Yep.
good.
Hey, no one tells me what to do. You know that, Jeff.
Right. That's why I said it's not me.
So we're going to do a brief presentation today. I want to keep it very high level for you. We're going to have a Q&A session at the end. And then the ask is AJ and I would love for you to reach out to us and just schedule some time on our calendar. It doesn't have to be anything super official. We can meet over a cup of coffee just to discuss your book of business and ways to scale and grow, or to, rate your financial health personally. But again, today we're going to focus on the value of time helping you and your clients. And so time, when we think about that, that's really our most important, our most valuable non-renewable asset. And what I mean by non-renewable is we can't make more of it, right? It's the one thing that we can never get back. So we often think of money, right? And money, we spend it, we can make more. The stock market, if you're investing your money, it goes up, it comes down, it's volatile. Even careers. For many of you, I know some of you on this call, this was not your first career, right? It's your second or your third career in your life. But time, once it's gone forever once you spend it. So it's especially important to think about time when you're crafting a financial plan. The earlier that we start, and when I say we, I mean AJ, myself, you, the earlier anyone starts a financial plan, the more time you give investments, right? The potential to grow in the market. The more time you give to have insurance and protection strategies remain affordable to the family. The more time you give to manage debt strategically, because we all have debt, right? And there's good debt, there's reasonable debt, and there's bad debt. So the longer time we have to manage all of that, the more efficient you will be. When someone delays time, they lose the most powerful factor working in their favor. And that's exactly what Jeff was talking about, compounding. And so it could be compounding in the market, but compounding time is your best friend when thinking about your financial health. Real estate agents in particular, you understand the value of time, right? So if you list a house too late, you might miss out on the market boom. If you delay giving clients advice, maybe you miss out on that opportunity. So the same is true for your own financial life. You will do yourself a disservice if you say, I'm going to put this off until later. This is one of my favorite charts to look at. And I hope when I explain this, it kind of gives you like a gut punch, right? It hits home. It's an aha moment. So this is, in full transparency, this is published by Franklin Templeton. They're a money management company. They have some great mutual funds, ETF offerings. But what this is meant to demonstrate is time in the market versus timing the market. And so you hear this a lot, right? I'm trying to time the market. I'm day trading. And so what this graph is showing you is it's going to go over investing $10,000 into the S&P 500. And the way I explain the S&P 500, for those of you that don't track it on TV, it is literally the biggest, the baddest 500 publicly traded companies on the US stock exchange. So we're tracking a major indice with this example. And so if you were to put $10,000 into this on January 1st of 2005 and let it sit for 20 full years up until December 31st of 2024, this 10,000 would have turned into $71,750 without adding to it at all. And when Jeff did his preview for this, he called this, like, I think Jeff, you said something along like making money while you sleep. This is what you were referring to, I'm imagining, in your preview. So we put it in there. 10 turns into $71,750. But it's really important when we talk about time to frame it in the right way. So I'm not talking about timing the market. I'm just talking about setting it and forgetting it in this example. If you miss just the top 10 best trading days over that 20-year period, and I want you to think really hard about that. 10 trading days over 20 years is such a small sample size. If you miss those, suddenly that 10,000 only grew to $32,871. That's a big difference,
Wow.
right? And then let's take it a step further, and you're looking at the green on your graph or the purple. If we move over to the purple and we miss the best 30 days, and again, 30 days is a month, but over the period of 20 years, that's not very much to miss. You only turn that 10,000 into $12,948. That's again a massive difference. And I think the numbers speak for themselves, is what I say. Of course, investing involves risk, and I am required by my compliance department to tell you that past performance does not guarantee future results, but the concept stays the same. And it happens that most of these market days, the good days, actually occur during or directly after a downturn.
Mm,
And so when you hear someone say, I sold to cash to stop the bleeding, that's an example of missing those top days, right? It is very easy to make the decision to sell out. It's very difficult to know when to move back into the market. And this is an example of why staying invested is incredibly important. Our job, AJ and I, we need to help clients minimize emotional decisions. So managing money, that's one of the things that we do as a financial planner, of course, but really we need to make sure that we're removing the emotion from your decision making process and focusing on long-term growth potential. And Jeff, this is probably what you were talking about when you talked about your 401k, right?
right. I
Starting
mean, if
10 years sooner.
I had 30, almost $40,000 in there in the year 2000. So imagine what that would be today if I didn't have to touch it.
Correct. Yeah. And I'm going to switch these slides over to AJ because he focuses as the insurance expert on the team.
Cool. So the other side of what we talk about, the delay in making those financial decisions, right? The life insurance side, the protection side, the defensive side of the football. One thing we know about life is that we don't get any younger as time goes along, right? So when you're looking at these protection coverages, life insurance, disability income insurance, generally the premium increases as age increases, right? What else increases as age increases? Your health changes, right? Sometimes we find some comorbidities that pop up that come along, high blood pressure, our blood sugar goes crazy, right? So we like to encourage clients to help protect that income as early as possible,
Mm-hmm.
right? And so I like to focus on milestone moments in people's lives, getting married, having a baby, buying a house, right? We know that as soon as someone buys a house and signs on that piece of paper, what happens is the first piece of mail they get is, hey, you need some mortgage insurance if something were to happen to you, right? And it's such a limited protection item that, that's where we think term life insurance comes in. It's generally inexpensive compared to a whole life policy, right? And there's additional benefit outside of just paying off your mortgage. So the next slide is just a quick case study that we showed you, and it's going to show you the difference between waiting, right? We're going to take Alex and Jordan. Alex is 30 years old. He's healthy. He's a non-smoker. We have him rated at just a standard level, right? He gets an A rating, not an A plus, not a B. He's just average run-of-the-mill healthy. He's going to get a $500,000 term policy for 20 years. It's going to cost him about $25 a month. Over the course of that 20 years, his total net outlay is around $6,058, right? If Alex waited 10 more years like Jordan, so Jordan, he's healthy, he doesn't smoke, okay? Same policy, 20 years, $500,000. He's going to pay $36 a month. And at first we're like, not bad. It's only $11 more. I can swing 11 bucks. I'll just skip Starbucks twice a week, right? The total cost over 20 years is $8,666. Because he waited 10 years, he's costing himself $2,608 more in premiums, right? And he took that risk of 10 years. A lot happens between 30 and 40. Trust me, I'm there right now, right? Health-wise, everything can change. So he took a lot of risk financially as well as on the health side of it. So the same logic also applies to disability income insurance. The younger you are, the better the pricing and the stronger the coverage options. What we did not illustrate, and it's a conversation that we have with every client, had Alex or Jordan's parents made this investment
Mm.
when they were born, 4, 5, 6, 10 years old, into a whole life policy. So
Mm.
it's about the same premium. I have it for my kids. Carmella has it for her kids. I know Jeff invested in Ty, right?
Yep.
You open up an unlimited world of possibilities when it comes to cash value of whole life, and it's the same dollar amount invested within that policy, right? So the sooner you get on that side of the ball, that defensive side of the ball, the stronger it's going to be in your financial profile.
And then think about if you took that 2,000 that you saved and invested it in the last slide that we have, right? Just in the S&P 500. So it all works together for your financial future. And the same goes for disability income insurance. So this was focused mostly on life insurance. Disability insurance is something that covers in the event you're not able to perform your job duties in full or limited capacity.
Hey, can I ask a question on that last slide here?
Yeah.
So all the TikToks of the world are saying be your own bank, right? Get a policy and be your own bank. Does that apply? Like if you did this for your kid, like AJ said, at birth or up till 5 years old, and you're building that up, the kid can take it over, right? Once they can handle it financially themselves, but then can't they borrow against that and be their own bank? Is that a thing?
Yeah. So I'll give you I'll give you an example of
Yep.
mine because it's a real life situation, right? I
Yep.
am guilty of waiting to start this on my kids, right? But each of my kids has a whole life insurance policy, and it's a morbid conversation to have, right? But because I make that investment, it's like $30 a month per kid. So $1 a day I'm investing in my kids on these life insurance policies. When they are 35 years old, my youngest will have access to about $45,000 of interest-free and tax-free cash value,
Wow. That's a
right?
big deal.
IRS can't touch it at 35 years old, right? When he's 65, that number is 6 digits, right? Again, IRS can't touch it. He can lend it to himself at no interest. He can pay it back or he can not pay it back. It's up to him,
Wow. Yep.
right? But at retirement, how many people at retirement are going to be handed a check for 6 figures free and clear? Not to
Off
your
$1 a
retire
day.
your
Right.
retirement's not going to do that, right? Your what's in your bank is not going to do. You're still paying taxes on that. Like this is literally, I don't want to say free money because you're paying for this
Right.
policy, but it's access to tax-free cash value that does not have to be repaid,
That's good.
right? And so when I tell people this, Warren Buffett actually has a quote that, somebody is sitting in the shade today because somebody planted a seed for them,
Right.
right? And that's how I choose to look at this for my kids. I plant that seed of $1 a day for each of my kids so that my legacy, when I'm no longer here, they can sit in the shade, right? That tree is going to grow from that seed and they can sit in the shade and have what I wasn't able to have.
That's so good. I love that analogy. I never heard that before. That's good.
And we didn't want to get too in the weeds on the whole life policy because it gets a little confusing. But yes, Jeff, it's those policies, to AJ's point, they have tax-free growth in them. They are wonderful vehicles. They're also non-correlated to the market. And you've heard me speak about this a million times. So they grow one way, the cash grows up. So in years where we have the market misbehaving, when it's not our friend, it's very nice to look at your balance sheet and say, I may be suffering some volatility over here, but that's okay because I have tax advantage funds that are continuing to grow that I can use over here until it recovers.
Yep.
Jeff's favorite topic.
Let's go.
It might be your favorite topic, it might be your least favorite topic because it might wreak havoc on someone you know. But student loans. Student loans, there are plenty of strategies that AJ and I can help implement with you or with your clients. I mean, I can't tell you how frequently, Jeff has somebody and we're able to work a strategy in the student loans. I send Jenny and Corey a copy of the new data sheet, and suddenly we're rocking and rolling with the mortgage. But time is very, very important here. It's time meaning starting early, but it's also paying attention to what you're doing and meeting deadlines. So student loans, that landscape is truly ever evolving. And if you know somebody that's kind of specialized in the student loan landscape since COVID, like we have, it seems like things change daily. Every so often, there'll be just a rift in it. We can't plan for that. We call it legislative risk. But long story short, there's federal and there's private loans. On the federal loan side, there are programs considered income-driven repayment programs. And there's also something called PSLF. If you've ever heard that acronym, it stands for Public Student Loan Forgiveness. And that word forgiveness is right on in there. You will be rewarded for starting early with this type of strategy. Okay. If you tend to miss, if you wait to consolidate your loans or you delay doing your income recertification, you could cost a borrower thousands in loan forgiveness credits. So there's not really a button that says, wish I would have done this sooner. Can I go back in time? So speaking to someone right away in regards to your student loan strategies is incredibly important. As a real estate agent, right, obviously you help buyers connect to someone who understands the nuances of the student loan landscape. So that's what you can do for your clients. And of course, it helps their budget. Maybe it gives them not money to put towards the mortgage in terms of saving, but the courage to buy that house, right? It gets them out of that uncomfortable range into the comfortable range. Because even if they're saving $100 a month on student loan payments, that's suddenly $100 a month that can go into an emergency reserve for when they need a new roof on the house. It is also going to help you build their trust. And that's something that's really important that can set you apart, I believe, from the competition, especially among first-time home buyers that are juggling a little bit of debt. When we're young, we all have debt, whether it's good, reasonable, or bad debt. So we can make a massive impact by being introduced to those young first-time home borrowers. Time and taxes, this is also something that's really important. I like to say I'm giving Uncle Sam my fair share, but I don't need to give him a tip. So we have to leverage the calendar. So often, I'm guilty of this too, and AJ yells at me all the time about my taxes. As business owners, and most of you on this call are business owners, right? As real estate agents running your own practice, you are faced with the reality of having a complex tax situation. And we need to start treating this as though it's a year-round process and not something that we only talk about in March or April of every year. Okay, and your clients need to treat it the same way. For real estate agents, if you're 1099 income and considered a business owner, some options to consider, and I have to tell you, compliance will make me say these are not direct recommendations. You need to talk to us one-on-one. But many of you are eligible to set up something called a SEP IRA or a simplified employee pension plan, or you could set up a solo 401k. But those need to be set up prior to December 31st in order for you to make contributions into those accounts that are deductible from a federal income standpoint. Okay. You can also prepay January expenses. So maybe in December you had a really great year and you sold a record number of homes, right? Maybe you want to prepay things like your rent or your subscriptions or any of your business expenses to get them as a deduction in the tax year when you need them most. You could buy a laptop or a phone or some type of equipment that you can depreciate prior to December 31st, and you qualify for 100% bonus depreciation. You could track mileage. I hope that you are tracking mileage. There's many different, apps that you can use for this, but make sure you're giving screenshots of your odometer, checking in for quarterly estimates. Don't wait till the end of the year to take advantage of that. And then make sure that you are working with a tax professional to make your quarter four estimates on time and in the appropriate amount to avoid penalties and interest. And I'm sure a lot of you on here have had an instance where you owed penalty and interest because you weren't working hand in hand with someone. Considerations for clients, and this could be if they're business owners or if they're W-2 income. You may want to encourage, say you have someone in the winter, you may want to encourage them to close early, right? Because then they can deduct not only mortgage interest they paid that year, but also the property taxes. You may want to have them speak to someone about selling investments throughout the year to leverage and harvest gains versus losses. And that's called tax loss harvesting. It's complex and I won't get into it now, but they shouldn't be waiting till December or January to make those decisions. We should be helping them all year long. You might want them to make maximum contributions to their HSA or their FSA, right? For a deduction on federal income past their 401k. They can use energy efficient home upgrade credits. They can gift. So this could be for a down payment, mom and dad, grandma gifting for a down payment to help Jeff get the mortgage cleared. But in 2024, you were able to gift $18,000 per recipient. You have to gift that prior to December 31st to get the credit for that year. But this year it went up. This year it's $19,000 per recipient. So the whole point of this slide, again, is just to get you to focus on the fact that you shouldn't be putting taxes off and talking about them once a year. You should be implementing strategies throughout the year that help reduce that burden later on.
Man, I want to dance on what you just said for a second because you just dropped so much gold. And like I know you probably take it for granted because you know this stuff inside and out. This is why you need a team of trusted advisors, right? And the two people that I think are super critical, number one is a financial planner. That's like the number one most important you need in your corner. Yes, you can afford it. There are ways to do it. You don't need to be a millionaire to do this. So don't let that be friction to hold you back from having that conversation. We got 18-year-olds and 20-year-olds already connected that are investing in their future. They can afford it. So can you. It's absolutely for everyone. And I say this with passion because I've dodged financial planners for decades because I'm like, I can't afford it. That's only for the big wigs. That's only for the rich. And that's just not simply true. And Carmella and AJ are dropping gold left and right here. And I know it's probably too much for any one person to take on. That's why you need a team. That's why you need a trusted team of people in your corner, and then a financial planner or a CPA, right? Having a CPA in your corner is critical. And I'll tell you, there was a guy I used to party with in the 90s. Absolute, so much fun to hang out with. In 2015, he started calling me going, Lagoni, you don't need to make more money. You need to pay less in taxes. And I'm like, he's nuts. I'm not listening to him. I dodged him for like 5 years until he sat me down. And I'm like, oh my gosh, how did I miss this boat? So as much money as I invested in the government and paying taxes and over tipping them, as Carmella would say, I could have used and be retired right now, right? With the right plan. So this is where my passion comes in. When you guys refer somebody over to me, that's why I'm like, let's hit the pause button on the mortgage products for a minute. And let's look at this bigger financial picture into what AJ said. You can leave a legacy for your kids. Your kids can sit in the shade for a minute. Not that we don't want our kids to work, but we want to give them a step up more so than what we had growing up, right? Every parent wants better for their kids than they had. So I just wanted to pause and say, how important it is of everything you two just dropped right now.
And also compliance is going to make me tell you we are not licensed to give tax or legal advice. It's just ancillary to what we do. But to Jeff's point, our biggest speech when we give it to clients is, when's the last time your financial planner, your accountant, and your attorney all sat in a conference room and talked about what was best for you? And 99% of the time, the answer is never. And so we don't work with just the ultra wealthy. In fact, we're going to give you an example in 2 slides on a perfect candidate to be a client for us. But we are available for free consultations. There are no cost, no commitment, just to talk through any questions you have. And that's really where I would love to begin the relationship with anyone who's interested. I'm going to talk a little bit about burnout, and I know we're running low on time, so I'm going to speed this up. But in your industry in particular, from working with agents, AJ and I have discovered there's a ton of burnout, and it's kind of like the perfect storm for you. So it's hard to blame you that you get burnout, right? Your income is unstable. It's not predictable. That's hard on the family budget. You have long hours. I think clients even themselves don't realize what goes into making sure that these deals get to the closing table. And there's high emotional stakes, right? You're dealing with people at the height of their emotions, and it's coming back on you. We have found that financial stress compounds the problem, right? So compounding can act in a good way. Financial stress compounds it in a bad way. And that's when you make bad decisions because you don't see the light at the end of the tunnel. So we have found that when you have a clear plan for saving, protecting income, reducing tax surprises, handling emergencies, you can focus on doing your best work at your job, in your company. And when you feel financially stable, your clients are also going to be easier and much nicer to work with. As a financial planner, we're just here to guide you. We're here to reduce stress, build strategies, and we want to design them to protect both your income and your mental health long term. I'll give you one example in terms of a client, right? This is Jamie, and Jamie's a real estate agent who started working with us at 31 years old. She was not making 6 figures, not by any means, but she did something very important. She committed to a plan. And so year 1 was very small, right? Year 1, she started saving $250 a month into a Roth IRA. She implemented some very basic term insurance, which AJ went over, and she had a disability income insurance that she had. Nothing flashy, just simple protective strategies. Over the next 3 years, we worked to build an emergency fund, and we tracked expenses for her using MileIQ and QuickBooks Self-Employed. By year 5, she had opened up one of those solo 401ks that I spoke about, and that helped her defer taxes on the commissions she was earning. And by year 10, not only had she grown her net worth by over $200,000, but she suffered a minor injury and a portion of her income was actually covered through the use of that disability policy. So this is an example of how it's not income that is the biggest factor in your financial success or your financial health. It's consistency, time, acting now, and making small steps along the way. And I also get this question all the time, like, why would you work with a financial planner? Why would you as a real estate agent, why would your client? Working with financial planners, as I've said a couple times, it gives you an edge. It's maybe a service that your clients aren't getting from the competition. Most agents do not offer this type of service. And I think it kind of shocked AJ and I when we started meeting with you. I have some of you on this call as clients. You don't get this advice on owning your own business from anyone else. You don't have anything ensuring your income year to year, and you're on the road every day of your life. So clients often face financial confusion, and so do you when buying or selling a home. Maybe they're confused about what mortgage option to go with. Maybe they're concerned about how much they can afford, right? Maybe they're confused about how to manage their debt or what the tax implications are going to be. That's where you can connect them with someone you know, like, and trust. And you're going to hear me say that a lot if you work with me. You have to know, like, and trust who you're partnering with. And that's when you become more than an agent, right? You become a guide for them. You point them in the right direction to have them have signs of success. And so when you refer a financial planner like ourselves, it's about more than just a sale, right? You're really becoming someone that cares about the success of your client. And clients are going to remember that. They may refer somebody to you. They may come back to you as a repeat client. But in this example that I went over with Jamie, when she did become partially disabled and had to go on claim, her clients started asking, how are you so financially stable? How are you so organized? And that's when a relationship developed for a very natural referral source for not only other agents, but also clients. And so I'll leave you with a couple pieces of advice. The first thing is you have to leave this presentation recognizing what time is, right? Time is your best friend in your financial plan. It is not income. So for some on this call that aren't having their best year ever or are just starting out and are working a second job, it's a perfect time to get in touch with us. You can't wait for that perfect moment because that perfect moment is never going to come, right? And you're going to put it off forever. Second, I want to make a challenge that if you're sitting on this call and you are not either insured yourself or investing, you need to take one piece of action this month. If that action is to reach out to us or someone else you trust to schedule a meeting, that can be the action step, but you need to act now, right? And if your clients haven't made a plan, introduce them as well. Third is I want you to look at referrals a little bit differently, right? It's not that you're referring to someone, you're not referring someone to us to make a sale. It's not something that you need to explain to them as salesy. Like you should really buy some insurance. Again, you want it to be a smooth handoff and you want them to know that you have their best interest in mind. And typically what AJ and I have seen is honestly, your reputation grows and you're viewed as more of a true professional. If you have any questions, I know we went way over time, but again, we're always available for a consultation. I'll put my contact information right up here. You can call and text, you can send an email. Jeff, I can even give you a brochure with contact information that you can send out after. But I want to thank everyone for having us today, and I do hope you learned a little something.
I think we had a question here. Go ahead, Christy.
Yeah.
Yeah, my question is, you had mentioned earlier about the best trading days, with that chart, how do you know what the best trading days are? Is it just a matter of being in it all the time so you get it, or how do you know what they are?
I don't think you do know what they are, is the question. So I'm going to sit here and say it's impossible to predict what the best trading days are. And it's also impossible to predict what sector of the market will do better each year. And if someone's telling you that they can predict the market, in my opinion, they have a crystal ball that we don't have access to. So what you don't want to do is you don't want to try and time the market for that reason, right? So let's say that you were nervous about volatility in the market and you took 20,000 and you sold it to cash and you said, I'm going to get back in when it's the right time. The right time, you're probably going to want to see some forward momentum for more than just a day, right? You're going to want to see some long-term momentum so that you feel secure putting that money back into the market. By trying to time it, that's where if you miss the best day, you suffer long-term. So not saying that you can't make moves, right? Your advisor can speak to you about maybe we reposition from energy into consumer discretionary or so on and so forth. But you want to look at investing as a long-term asset. You shouldn't have money you need in a year invested in equities.
Thank you. That makes sense. So,
Did that help?
yeah. So what you're saying is if you always have something in there, you'll get those waves also, but your chart was about pulling money out and trying to put it back in.
You've got it. This
Okay.
chart is illustrating staying in the market and you never made any changes, right? It was a vanilla, boring portfolio tracking an index. You turned 10 into 71,750. If you tried to time the market and missed days, even missing 10 of the best days over 20 years, suddenly that 10 grew to 32.
So I don't want to be political here, but would an example of that, I know there were a lot of investors recently that were pulling money out and back in because of tariffs. They were kind of trying to hedge their bets a little bit. So that would be an example of, in a way, what not to do. Don't pull it out and.
Well, and that's a very general, I'd say you need to be working with someone that has a plan for you. So there are strategies to hedge against different kinds of risk. Hedging against inflation risk, hedging against individual concentration risk, hedging against tariffs. So there are strategies that you can implement where you may see some movement, but it's something you want to work with a professional, in my opinion, to have a plan for. But moving to cash is not an option that AJ and I would recommend. We may have a plan to hedge against a risk, but we aren't saying, I agree with you, let's sell to cash, sit on it, and when times are good, get back in, because you are locking in that loss. If you have 20,000, right, and you sell when it's worth 10, it's worth 10, right? It was a realized loss. If it's in the portfolio and it's worth 10, we call that an unrealized loss. You haven't locked it in yet, and the market is a roller coaster. It is not going to be a straight ride. There's types of products you can implement to help buffer, right? So some of your portfolio may be a little bit more conservative. But yeah, long term, I would say staying invested and having a plan to hedge against problems is your best strategy.
And Jeff, is it possible for you to send out Carmella and AJ's contact information if we want to email them or?
Absolutely not, because Carmella's compliance department will yell at me about something.
No, you can send it out. And when you
Yeah.
talked about TikTok, that's why I laughed, because AJ and I would love to go on TikTok. We can't. It's
I
not
know.
allowed with a broker. So I always say, if you're hearing advice on TikTok, and the kids laugh because I call it the TikTok. If you hear advice on TikTok, you maybe want to research that a little bit or talk to somebody, because they probably aren't licensed with a broker, because a broker would not allow them to be on there giving advice of that nature.
And so there's two things I want to cover real quick. Are there any other questions for Carmella before I just want to talk about two things for us? So if there's a question, just hit it in the chat because I'm looking at that. But to Carmella's point, you know, as agents and loan officers, when we got into this industry, we didn't know we were putting ourselves on house arrest, right? And by what I mean by that is our phones ring, 7 days a week? Because people are buying homes nights and weekends, 9 to 5. Like, as much as I tried to say I'm not going to work Sundays, I still have to work Sundays, because you're going to die on the vine if you don't pick up the phone, right? They're just going to go somewhere else. So you're literally on house arrest, answering that phone nonstop. The other piece of that is this: once you close a loan or once you close a transaction, you're unemployed, because you have to go get another one to get a paycheck next month. So, you know, we don't have residual income, so we have to keep getting after it. Now, if I knew Carmella, you know, AJ's too young to know him 20 years ago, but if I knew them 20 years ago, I mean, AJ's like 25 years old or something. It's crazy. Like, I always think he's older than what he is, but he's not. Man, I wouldn't be in his position, right? I would have that stability added to it. And for knowing them and trusting them and knowing them and knowing that they're competent and they're always going to do right by my clients, they've added so much value to the conversations that I'm having with my clients. So beyond just yourself, you need to be having these conversations with your clients so that you're helping them as well, leaving a mark beyond what you already do phenomenally as a real estate agent. And I want to play a quick video for you. I recorded this yesterday, but this is an example of what I send to your clients when you refer them to us with their options, right? Can you see? Well, let me make sure the volume's on here. Can you guys see my screen?
Yes.
Hold on one second.
Not now, but we could before you stop sharing.
Now, can you see that?
Yep.
Yes.
To me, you can hear this too. Hey, Mr. Growth, Jeff Lagoni here. It is 11:32 on August 19th. And I'm saying that because rates change every day. And these are the rates you're looking at right now. I just want to walk you through what your options are. If you look across the top, this is the title of the loan program. So we got the KHL, stands for Keystone Home Loan with FIT. FIT stands for forgivable intent, meaning they're going to give you 5% of the purchase price. So in this example, it's a $500,000 purchase price. They're going to give you $25,000 interest free, and it's forgiven over 10 years. And so you don't have to make a payment, and there's no interest collected on that. So in this example here, on a $500,000 purchase price, putting 5% down, that rate today is 6.875. Your monthly payment, including taxes and insurance, will be $3,950, and you need to bring $20,400 to close. Now, you can get this same Keystone Home Loan product and forget about the free money, the interest-free money. If you do that, that rate drops to 5.875 versus the 6.875. And what does that do for you? That drops your payment $310 a month. So your payment goes to $3,640 versus the $3,950. But the trade-off is you need to bring $45,000 to close versus the $20,000. So you're bringing $25,000 more to save that $310 a month. Now, you can put 20% down with this Keystone Home Loan, so you still get that great rate. You can put your 20% down. Your payment goes to $3,160, which is almost $800 less than the original monthly payment. But again, the trade-off is you're bringing $120,000 versus $20,000, so you're bringing $100,000 to save that $790 a month. Now, what I did was I took this last column and used this product right here, but I said, let's just invest the difference between these two. And what does that look like? Because we want to look beyond just the rate and the monthly payment. We know every penny counts, but we also want to make sure you have more money in your account 5 years from now, because you can't spend the money in the walls of the house. So once you put that down payment, you'd have to call somebody like me to do a cash out refinance. And most banks aren't going to let you access all that equity. So let's see what that looks like. So if we come over here to the reinvestment tab, the difference was almost $100,000 of what you were bringing to close. Now, I am not a financial planner, but let's just assume you got the average rate of return that the stock market has returned over the past 50 years of 10.2%. Then in 15 years, you're going to have almost $500,000 saved. And what does that do for your overall picture? When you look at your net worth, now in 15 years, you got a net worth of $600,000 versus the $217,000. So we want to look at that whole financial picture. But let us know which option you prefer, and then we'll get you started. Talk to you soon. Any questions on that? Carmella, anything to say about that? Like these are the conversations we're having up front where people are like, I've talked to 4 other lenders. I'm just staying with you. Right? Because
Well, and I think when you work with someone, then you want them to coordinate the team. Like when we work together, I'm involved in those conversations.
Yes.
So you usually send me a copy of that and I'm reviewing it with the client with you at the same time. And we're making a decision together. And it kind of is an easier experience for the client because they understand that they can afford it. We talk about what we're going to do with funds if they're not placing them into the mortgage. So it just brings the entire team together and it's a seamless communication experience for the client.
Right. That as agents, this is a value add that you can give for your clients as well. And then the last thing I want to share here is this, right? So a lot of you are already familiar with it. This is our quick qual app. So after the customer picks the option they want, then you have it and they have it. They simply come in, they type in the offer they want to put in. They usually just have to change the taxes of the property they're looking at.
Yeah.
It'll show them breakdown of their monthly payment. Are they comfortable with it? It'll show them what their cash to close is. Are they comfortable with that? If that's the case, they can text you the pre-approval letter right now, right? I've been logged out, but it'll generate a pre-approval letter. for you. And then they can text it or email it right to you. And oftentimes people are like, Jeff, how are all your people going under contract? And it's because we're delivering two things: speed and certainty. The certainty is the customer's comfortable with their loan program. And the speed piece is that they're getting their offers in on nights and weekends, like right now, and they don't have to wait for me to log in and give them a pre-approval letter. So just know that those things are working for you as well. Any questions? Anything to add? Comments? I think Sharon's trying to unmute. I see her hand going up. Go ahead, Sharon.
I will say Carmella and AJ know their shit.
Yep.
Like, I mean, you know, when you find someone that knows their stuff, like the stuff that comes out of her mouth is blowing me away.
Yep.
Like they know their shit so good. So it doesn't hurt to have a conversation with both of them because they really do know their stuff and can guide you all the way to help you. I wish I would have known them years and years ago. Like, how wealthy would I be right now and not working, you know, 60,
Retired.
70, 80 hours? Seriously,
Yes.
seriously. I wish I would have met them a long time ago because the knowledge that they have, I can't even like, you know, understand how she keeps it in her brain.
Yeah.
So yeah.
I blame AJ. I mean, AJ's known her for a long time, and he just kept
She
her under
pushes me.
wraps.
She
Yeah.
pushes me. Like
Yeah.
she does. Sharon's right. Like I can't keep up with her.
Yep.
No,
Right. And
the
every day I talk
knowledge.
to her. Yeah. Every day I talk to her, she's throwing something else on me. But whoever's recording this, I want the reel where Sharon says Carmella and AJ know their shit. And I'm going to
Hey.
try to get that.
Yeah, we
Hey,
need
I'm
it
gonna try
right
to get that
behind
past
us.
her.
I was
We're
literally
getting t-shirts.
I was going to just ask Sharon, can we take that snippet of you saying that? But we're going to have to put some beeps in there for
Oh,
Some
Come on.
asterisks.
Bloop, bloop, bloop.
Right,
Some
yeah.
asterisks.
I was
Yeah.
trying to be polite on this. I was
Zero.
really trying.
Zero
I,
chance.
like seriously.
That's PG for you.
Yeah,
Yeah.
it is very PG for me.
Yep.
But I'm telling you, the knowledge, it just blows me away.
Yep.
Yeah.
So good.
Thank you
Christy.
so much.
I just have one more quick question. Do you ever have clients, have you ever worked with anybody that, you know, like you can get together and have fractional ownership of an airplane or a business or something? Have you ever had people come to you and, because it does seem like you can have higher rewards with more invested. Do you ever have a group of people that do that collectively, or is that even possible?
Yes. Often it's within same families, but yes, it is possible to do that. Obviously, there's a lot of disclosures, and you want to make sure that the entire team is aware of who's in charge and what tax cap consequences are. Typically, I'd say that it's not a bad strategy. Where it does result in some issues among a pooled team of investors is when there would be something like an ad. So let's say that and I couldn't invest with you, but let's say that you said, I'm going to invest with Sharon and I'm going to invest with Deb and I'm going to invest with Jeff, right? And so you're all pulling your funds together, and Jeff has his best year ever, and he doesn't want a tax burden by selling a highly appreciated security to reinvest into a new option. But both of you decide it's the perfect time to do that. He's going to take the tax hit and he's outvoted, so there's nothing he can do about it. So I'd say it's something you just want to make sure, again, you know, like, and trust who you're partnering with, but it is possible. Is it worth it and is it necessary? We'd have to talk one-on-one to see what your situation looked like. Does that
Yeah,
make
the first
sense?
Mhm.
So you have to play nice in the sandbox if you're commingling your funds.
I
First time
accidentally
I
hit
heard-
my video and not mute. Yes, it does. Thank you very much.
The first time I heard that was a 19-year-old kid looked it up to be a fractional owner of a horse at a racetrack.
Yeah. Most
So I didn't even
horses
know that was
are
a thing.
fractionally owned.
Yeah,
It's very rare
yeah.
to have one, especially around here with the meadows.
Yeah.
I have a vet that works on a lot of them, and most of them are fractionally owned.
Yeah.
Mm-hmm.
Good deal. Great call. Man, I've been looking forward to this one for a long, long time. So thank you so much, Carmella. I feel like this is a great meeting that's going to impact a lot of lives, right? So not just the people on the call, but their clients as well. If you guys need anything, you know, just reach out. We're going to send the replay out here in a minute with Carmella's and AJ's contact information, and make it a great day. We'll see you guys. Thank you for spending time with us.